YummySounds.com layout track.
So what's up traders, this is J Profit FX right here. So on today's episode, on today's video, I'm going to be talking about that biggest secret your mentors out there are not telling you, or that biggest secret they fail to touch upon when it comes to trading. All right, so but before we proceed guys, kindly subscribe or follow me guys on Instagram. If you've not followed me on Instagram, you see educational content I post on Instagram. You can as well be educated over my Instagram page. Now let's proceed guys. So what's that biggest secret that your mentors out there and telling you, right? Okay, in case you don't know or you don't know, I'm just gonna text it for you. Risk management. Risk management. All right, so now, but before I proceed into this video, please, if you're not subscribed or you're just joining us newly, please kindly subscribe to this video, turn up your notification bell, and so you'll be notified when next I post on this video. So I'm all about smart money concepts. I do post smart money related videos, right? So now this particular risk management is part of what smart money concept, or is part of what trading as a whole. Doesn't matter if you're trading price action, smart money, or indicator based trading, right? Now let me tell you something you don't know. Right now, out there you see your mentors, right, trade with like $1,000 account, and you see them making or flipping their account to like 2,000, 5,000 with, seriously, there's something they call full margin, right? Those your mentors out there, they normally go full margin on that account, knowing quite fully well that they have access to another fund. But you as a trader right now, you as a trader or a beginner trader, somebody who doesn't have a cash flow, let's say for instance the last money you have is what you paid for mentorship, $100, you have $100 left for trading. Now you learned what your mentor taught you, you think you're perfect on it, you want to practice or go live on a live account, fine, nobody is stopping you from doing that, right? Now the problem right there is when you try to mimic your mentors in what they are doing or in the way they are trading, right? So you can see somebody, you can see your mentor go full margin, for instance, have a $500 account, you see the person load 2 lot size on that account. The reason why they do such thing is that they have access to another fund, they already have cash flows, right? So as for you, a beginner trader, you don't have cash flows like them. Why would you want to risk such amount of money, or why would you want to put your whole account at risk on a single trade? Now let's go straight into the point. I'm going to show you guys how you can properly apply risk management. Now next thing I want to say is that forex is not gambling, right? Forex is not gambling. Risk management there made forex not to be a gambling. Okay, as long as your risk management is in check, you are not gambling on forex. Now let's go over to here. So if you want to know how to calculate your risk management, or the tool you're going to be using to calculate your risk management when it comes to forex, babypips.com got you, right? So we're going to use babypips.com risk calculator. Right now your account currency, let's say you have $1,000 account, right? You have $1,000 account, and in this $1,000 account you've decided what percentage of your account you're going to be risking per trade. What percentage of your account will you be risking per trade? Now you're not expected to risk anything more than 3% of your account, depending on the account size, right? So let's say I have a $1,000 account, I want to be risking something between 1% to 3% of my account per single trade. Okay, now I've chosen to risk 2% of my account per single trade. Now here it asks for me, it's asking for my account balance. I have $1,000 account balance. Now my risk percentage is how many percent of your account you want to be risking per trade. I'm going to put 2% right there. Then when it comes to the stop loss, right, you cannot determine your stop loss all the time unless you have a kind of strategy that tends to give you a particular amount of stop loss. All right, that tends to give you a particular amount of stop loss. But if your stop loss changes, right, because I know it will keep changing, because it's not the structure you get here that you get there, right? Stop losses are being determined by the structure of the market and the setup. All right, so let's say at a particular time we want to take a trade, the stop loss that we have is what 10 pips stop loss. Okay, and you know smart money is cool when it comes to stop losses. Any smart money that trades with more than 20 pips stop loss is just something else, right? So smart money trading, I don't think average I've seen, we don't pass more than 20 pips stop loss, right? So now you put in the pair you're what trading. You can see we have what many pairs right here. Put in the pair what you're trading at that current time or we want to trade. So I'll choose GBUSD now for this what a case study right here. So I'm just going to hit what on calculate. Now as you can see this thing change, it will now tell you what the exact amount at risk. So out of my $1,000 and I want to risk 2% of my $1,000. So the 2% in money or in dollar is what 20 USD. Now here is what the standard loss size or the loss size required for me to what risk this 2%. Okay, here's the thing now you guys are waiting for, or here's the thing that you people don't know how it's done. Your mentors out there, they calculate their risk management, and what once it starts giving them an exact standard loss size for that risk percentage they want to what risk, what they will do now is to what split that particular loss size given into different places. Now let's say I want to split this 0.20 loss size right here into different places. What I'm going to do is what, okay, let me say I want to start with 0.05. so how many 0.05 will give me 0.20 in total? Of course 4 0.05. So I'll literally split what this 0.20 loss size into 5 places. Now another advantage of splitting loss sizes is that it helps you take profits at different levels of the market. For instance, I open 0.20, right? And then if you're in drawdown and you want to take another entry, I don't know if you're getting me. If you're on drawdown, you want to take another entry and you've already taken 0.20 at a go, you will not have that what you won't have that what fair point or fair chance to what put another loss size, because what you've maxed out on your what 2% risk, which is putting the 0.20 once. But when you split this 0.20 into different what loss sizes, which what totals the 0.20, you'll be able to add position at different what points of the market. Let's say you added what 0.05 to 0.05 what lot size, that's 0.10 in total, and market goes in drawdown, you added what the extra to 0.05 into 2. Now from there market picks up, it still gives you more what risk to reward. Okay, that is how they do it. That is how they what put in multiple loss sizes. They don't just put those multiple loss sizes like that. They've already calculated it, right? 0.20 loss size, 0.05 into 4 is 0.20 in total. That's so I'm going to have 0.05 loss size into 4 places on my account, totaling 0.20. So that means still I'm risking 2%. Okay, now for instance, like I said, let's say right here, and I'll take a trade. This is the trade right here, and I'll take this trade, and the risk stop loss, like I mentioned right here, was 10 pips, right? Now, and that trade, what according to what where I want to take my profit at, what that trade gave me is 1:5. I'm just assuming it gave me a what risk reward of 1:5, and that trade what goes what right, or goes what into my direction and hits what my take profit. So once it hits my take profit, it's going to give me a risk reward of 1:5. So what this risk reward ratio simply means is that whatever you risk, as long as you hit take profit, whatever you risk, you're getting it what times 5. Here we have 1:5, meaning that whatever I risk as my stop loss, or whatever I risk in the market, I'm going to get that what risk times 5 as profit. So since here this is what our amount at risk, $20, so me getting $20 times 5 is what $100. So my $1,000 account is now what $100. So we have a total of $1,100. So I don't want to make this video so long. Let me try and shorten it right here. So now as I've had $1,100, now what it simply means is that for me to go on break even again, so far as I'm applying what this same what risk management of what 2% on my account, as long as I'm applying it, there's no way what the market can what tap into my capital unexpectedly. It will only what keep taking from my profit. Right now, second thing about risk to reward ratio, or second thing about risk management, well-planned risk management, is that when you apply this risk management, as you've gotten $1,100 and your risk to reward ratio that gave you that is what 1:5, it simply means that you will have to lose trade 5 good times for you to what go back to what break even, or go back to your main capital, which is $1,000. So for somebody that knows what he is doing in the market, can you be able to lose 5 trades at a row? Is it possible that you can lose 5 trades at a go? If it's possible, I don't know if I should say if it's possible, right, or it's not possible. I can't say. Okay, let's say we're able to lose 2 trades, right, at a row. We lose 2 trades, so we are left with what? 3 RR. They took away what? 2 risk to reward ratio from our 5 risk to reward ratio. We are left with what? 3 risk to reward ratio. Now we take the third trade, and that third trade now likely gives us what? Something like 1:7 risk to reward ratio. So adding up your 1:7 risk to reward ratio plus the remaining what? 1:3 risk to reward ratio, that makes it what? 1:10 ratio. So in total, your account is what? 1:10. Okay, now let me do it this way. Since I have $1,100 account now, as I've made a $100 profit, I still what? Put 2% right here. And now let's say my stop loss is now what? 15%. 15 pips. As I have here, I have 15 pips right here. Let's say my stop loss now on a new trade I want to take is 15 pips. Now let me calculate. So as you can see, it now changes, right? The amount at risk now becomes what? $22, and then they what? Gave me the what? Standard loss size for it. If I approximate this what loss size here, it's a total of what? 0.15. So meaning that if I split this 0.15 into 3 places using 0.05, that means I'm going to have 0.05 lot size in 3 places. Alright, so this is how it comes, this is how it goes. Now let's say I finally won this trade of 1:7 risk to reward ratio, and remember I lost a trade from my what? 1:5 risk to reward ratio, remaining 3 what? RR for me. Then I will add that 3 RR into what? My 7 RR. So 7 plus 3 is what? 10. So I have a total of what? I have a total of what? 1 is to what? 1:10 RR. Okay, what it simply means is that what I'm going to lose what? Trades 10 times for me to what? Go break even. Now let's check the profit we made from what? 1:7 RR. I risked 15%, which is what? $22 at 2% what? Risk. So I'm going to get back $22 times 7. That is 1:7 RR. So $22 times 7 right here is $154. So if I add $154 to my what? If I add $154 to my what? $1,100. So that's a total of what? $1,254. Now remember, I lost a trade right here 2 times. Since I lost a trade right here, let's check, and this is what? $22 that I lost each single time. So the first trade I took, I lost what? $22 on what? The time I made $1,100. I took a first trade, I lost it. So I lost $22. Taking out $22 from 1,100 is what? I'm left with what? 1,078 what? Dollar. Right? So I take another trade. I lost that trade. Now let me calculate. Let me see how much at risk. So how much at risk right now is what? 21.56. I lost the trade, so I'm going to minus this 21.56 plus $1,778 minus 21.56. So I'm left with what? $1,056. So now $1,056. Remember, I now made what? A total of what? So since I'm left with $1,056 right here, let's calculate. Now $21. And this is the balance I used to what? Now take this 1:7 RR trade. So if I check, I risk 21.12 trade, $21.12. So $21.12 times what? 7. I have $147. So $147 plus $1,056 plus $1,056 is now what? 1,203. 1,203. As you can see, risk management is key, guys. It is key. It is key, guys. It is what? Key to trading. Now, like I said, I have what? This $1,203 is what? A total of 1:10 RR. So it simply means I have to lose 10 times for me to what? Go back to what? $1,000. So this is how what trading works. Unless you decide now to what? Risk more than 2%. If you decide, the risk is all to you. If you want to risk 5% of your $1,000 account, it's up to you. Let's say I'm risking 5% right here at 10 pips stop loss. All right, the stop loss is not what? Steady. It is not what? Steady. It changes according to market structure. I'm calculating. So I have $60 at risk, and this is what the standard lot given to me. So if I want to risk 5% of my $1,203 account, I will split this 0.60 lot size in different places. That is how risk management works. Don't follow your traders, your mentors out there blindly. This is the secret they are failing to tell you. This is what the secret they are what failing to tell you about trading. Trade wisely, trade genuinely, trade carefully, trade well, not every day. So here comes the end of this video. This is JProfit FX.
YummySounds.com layout track.